what's so interesting about this is the sheer level, up 63% investment grade borrowing year over year in, I think, July, but also that it's kind of a reversal. Companies said that they would lighten up on their leveraging, and they've done the opposite. What's going on?
So first of all, it's important to look at this to know that like this analysis that Morgan Stanley had done to show that leverage right now in the investment grade index is broadly unchanged from a year ago. That's looking at it from a top-down level. So that's for the entire index of investment grade companies. That's roughly $5.8 trillion of debt outstanding. But when we look at it at an individual company level, there definitely are companies that are following through and deleveraging. A lot of the names that we talk about often, like AT&T, GE, AB InBev, but there are others that have not followed through or leverage that has stayed constant. And that's why at a broader index level, we've seen that it's stayed roughly the same. And definitely, as this chart shows, a lot of companies are still very much borrowing.
Didn't we talk about this last year when Scott Minerd came out and said that the collapse, the sell-off in GE debt was the beginning of the collapse in IG credit? Yes. So what happened to that? Is this all central banks?
A lot of it, yeah. I mean, you kind of look at this from the outside perspective, and if you're a corporate CFO, it's like, well, why not? Why wouldn't you borrow money right now? It's all there for the taking, and it'd be different if investors weren't just willing to lend at these rates, but they clearly are. I mean, all of the deals that we've seen in investment grade, at least, have been very well received, and it seems like there's plenty of cash to go around for these companies. So exactly, the question is, why not?
So the concern, of course, is there's some measures, including income to net debt, that are rising. Is the concern that we hit a downturn and/or income that interest rates should change, and that companies just aren't able to kind of manage it as well as they should be able to?
Right. Well, that's always the concern, right? And that the idea when you take on more debt, the idea is that it's supposed to stimulate growth, and that hopefully your leverage ratio will stay the same if you're borrowing to fund projects will then lead to additional revenue and earnings. But like you said, the pitfall could be is if economic slowdown, or God forbid, if interest rates start to rise again, that would then throw these plans off course. But right now, it seems that companies are still refinancing debt, and granted, October is going to be a much slower pace than what we saw in September, but there haven't been any broad issues yet.
So, Molly, are there any success stories you can tell us about where some corporations have actually cut down on their debt?
Definitely. So the ones that I mentioned before, like GE, AB InBev, AT&T, different strategies at all of them, but some are some combination usually of cutting a dividend or selling assets, usually, and using those proceeds then to pay down debt. So when AB InBev IPO'd its Asian business, for example, those proceeds went to pay down debt. They've also cut their dividend. GE did so too. AT&T has been more on the asset sale side, but all of these proceeds using to pay down debt.